Hello and good afternoon here from Berlin, Germany. I welcome you to today's weekly market outlook here together with Admiral Markets. My name is Jens Klatt, and in the upcoming 45 minutes, we want to get an overview of what to expect in the financial markets in the next week of trading. Some of you probably have looked at the chart in the last 60 minutes and have seen that there has been some serious volatility, let's say, when looking, for example, at the DAX. The DAX pushed significantly lower from trading around 12,700 points to 12,550, 560 points, only to reverse sharper now, or trade sharply higher now, let's say, and now trading back above 12,600 points, around 12,650 points. Has something to do with the comment from Donald Trump he made during an interview with CNBC, something we want to definitely have a deeper look into then. Before we start, first of all, here, let's have a look at the risk disclaimer. Trading with financial instruments offered by Admiral Markets carry a high level of risk, and this might not be suitable for all investors due to their complex nature. And before entering into any agreement or transaction, please make sure that you read the terms and conditions of the service from Admiral Markets. If necessary, consult a specialist to ensure that you understand the risks involved in trading, and investors should also study carefully the so-called KID, the key information documents, in order to understand the nature, risks, costs, potential gains and losses of margined products offered by Admiral Markets. There's sure the question why you should choose Admiral Markets for your trading. This is first of all to do with the fact that here in Germany, for example, Admiral is the so-called DAX expert, and really focusing on offering one of the most and highly competitive offerings in the DAX currently. In fact, the typical spread is not 0.8 points during the main trading hours, but 0.5 points, thanks to the 30th anniversary of the DAX here at the beginning of July. And this offering will continue till the end of July then. So you have still another 10 days if you want to test out the offering here with an even lower than usual spread, which is already one of the lowest in the CFD industry. Sure, one very important thing which will come up in the upcoming days then, in fact, 2 weeks from now, around from the 1st of August, is the Asthma Changes. And that means leverage restrictions for retail clients. There is different offering for professional and retail clients. Here is a very nice table where you can already see some of the offerings from Admiral in this context. For example, as a professional client, you do not have leverage restrictions. Interesting enough, usually there is no negative balance protection, but in case of Admiral, for example, if you are a professional client and you want to trade with the let's call the old leverage, the high leverage, you have a negative balance protection up to £50,000 according to the policy from Admiral, and anything above that. What I'd like to mention here is check out the website from Admiral Markets, where you can register for the webinars. I'll just show you in a few seconds how to get there. You can register for a special webinar series starting from the end of July already, or it's the 1st of August. I think we already start 2 days before on the 30th of July, I think on Monday already. Where 2 days before the Asthma Changes then take place and come into play, there will be special webinars held by Admiral Markets to make sure that you have an optimal start into this, let's call it an interesting period here, and that you're well prepared for all those changes happening there. If you already want to contact Admiral now before these changes come into play, please feel free to contact Admiral Markets. And now we want to focus here on the markets. First of all, let's have a look at the agenda as usual. So we want to have a look at what are the key economic events in the coming trading week. The interesting thing is the overall economic calendar looks quite thin. Okay, if we take out the ECB rate decision, that could be kind of a market mover, even though there is not so much potential for big surprises, thanks to the fact that the ECB already announced what can be expected in terms of the asset purchase program, the QE program here, and it will end in December. Respectively, this will be the last month in which the ECB will buy bonds, and then from January 2019 onwards, they won't buy any bonds anymore, and that we can expect rate hikes from the second half of 2019 onwards. The thing is, nevertheless, in which direction do we get to see comments from Mario Draghi here on this event, or during this press conference then on Thursday, next Thursday, what he thinks of the negative impacts, tariffs, or trade war in general with the US. What the negative impacts on the European economy could be, and how the ECB plans to counter them, or how the ECB plans to support the European Union, the member states here with monetary policy measures to make sure that there is no risk of negative economic impact, or that we drift into a recession here, something like that. So the next thing is that we want to make sure that we can grasp better what's the current bias in the FX, equity, and commodity markets. The current bias is in fact not economic data driven, but it's more a political statement driven, let's say, and therefore look at the chart of the last 60 minutes. For example, in the DAX, and just make sure that you see the price action. And if you look at the economic data docket here, you will just see nothing really happened there. But it was Donald Trump with this comment, so which already shows where the bias currently. It doesn't necessarily mean that the bias is on one or the other hand, but it's a potential driver, and based on that, you can then probably get a feeling of the current bias in the markets. And then, sure, the question which trading opportunities may arise. There's also one thing very interesting today: the Canadian inflation, then at 2:30 p.m. German time, in this case, or 1:30 p.m. London. When data disappoints, as it did last a month, it could mean that there is another push higher, and Canadian dollar, for example, is about to enter a new progressive move, which could then mean that we are about to push towards the region around 140. In fact, not necessarily next week, but in the upcoming weeks to months, then probably. And so now, this is the website from Admiral. I've already prepared it here. And it's not the main page, in fact, but it's the page you'll find once you go here on analytics, and there on the Forex calendar. So I won't change the website now. I want to keep this open, which already shows what I've already mentioned here, the ECB rate decision then on next Thursday, for example. By the way, time is London time, by the way. Okay, so not that you're irritated or something. That means if you want to have, for example, in German time, you have to add 1 hour here. And the webinar I was referring to, you can find it here via education and the Forex CFDs webinars. Let me just open this in a new tab then, because this is definitely very, very important. And this is here, you can see it. Those webinars, as I already said, starting at the 30th of July on Monday. And in fact, there are 2 with me too. So on Wednesday and on Friday here, 2 webinars where we will have a look at how the asthma regulation, the new asthma changes, will affect certain trading strategies here, and what you can do to reduce the risk of find yourself in a surprisingly negative spot here. For example, not having enough margin in your account if you're usually trading with high leverage in your trading, for example. And this is something we want to make a topic here during these webinars, the webinar series, which is held here by Admiral. And yeah, so now let's come back to the economic calendar. First of all, let's have a look here again at it. As I already stated, it's very thin already. You have only today the inflation rate here from Canada, and then next week, in my opinion, the ECB. Everything else does not play a big role. Probably on Friday, yes, GDP growth rate, Q on Q here, from the US, but all in all, I have to say that the overall week seems to be quite thin in terms of the economic docket. Nevertheless, thanks to Donald Trump, we have already seen that it's enough that he gives an interview here. What just happened? Have a look here at the DAX, and there is what I already mentioned, this sharp drop on the downside. In fact, now we bounced aggressively back. Nevertheless, now we're definitely red for the day in the DAX in this case. And what just happened was the following, that Trump mentioned during this interview here with CNBC that he's willing to put tariffs on all imported goods from China here. And we're not talking about 40 billion or 200 billion, but then we start to talk about 505 billion USD. This is, in fact, a very, very, very aggressive comment, in fact. Nevertheless, it's obviously right now not capable of really shaking the markets in some way. So short-term volatility spikes higher, yes, that's for sure. But nevertheless, obviously, the market can't really start to follow through because now the market gets somehow used to it a little. And what I consider to be really, really interesting is that, for example, the currency markets did not react at all. So when looking, for example, at the Euro USD here, let me just zoom out a little. And this is the hourly chart. So what you can clearly spot here is that nothing happened within the last 2 hours of trading. So if we go down, let's say now to a 50-minute time frame, let's have a look here. What you can spot is you can't spot anything. So if I didn't tell you that Trump made a comment, you will only see the chart and choppy price action, but no big moves in any direction. Nevertheless, the comments from Trump are good for at minimum short-term volatility, and also to some extent make a certain development, which I at least currently consider to be imminent, to make it more unlikely. So what do I talk about? You can already spot it here. So this is a 50-minute time frame now on a Euro USD. You can see a sharp rise in Euro USD here yesterday. That was at it was 7 p.m. German time, so 6 p.m. London. We spiked sharply higher, so nearly 1 cent within minutes. And the question is, okay, what just happened? And the reason for this spike is that Donald Trump made a statement, or the White House, if I'm not mistaken, it wasn't Trump himself, but there was a statement released, and I've found one. Where do I have it? I think it's here. Yes, there we go. So it's from a website, barchart.com. It's a great source of news around the market. And by the way, not only for such news here and for such an article, but also for the Commitment of Traders report we want to have a look at here, and why I say that I'm currently really bullish for the US dollar. Unfortunately, now with the comments from Trump, the picture is not as clear anymore. But the thing is that yesterday in the evening, the following happened here. Trump told CNBC in an interview, I don't like all of this work that we are putting into the economy, and then I see rates going up. So the thing is, and this is the interesting thing about this, is that Trump also said that he is not, or that wasn't Trump himself, but it was the White House then and the state later. Something very important to mention here. The White House said that Trump nevertheless respects the independency of the Fed and is not intervening here in any way in their work or something, which means yes, he is. Well, I mean, let's just face it. If a politician or if someone, a speaker for a politician, for president, prime minister, or whoever, has to make sure that people really understand, or has to tell the people how to interpret what the person just said, you can be sure that what the president, prime minister, or whoever just said is definitely to be understood the way you already interpreted it. So you don't need someone who tells you, well, by the way, he respects the independency of the Fed, because you can, based on this comment alone, see that he obviously does not like the independency of the Fed and obviously wants to intervene. in their current rate hike cycle, for example. And so the interesting thing about the, the reaction was quite clear, was sharply US dollar bearish. And now, also with those comments around China, for example, I think it's only a matter of time once Trump finally will address this development here in the Chinese yuan, which we already get to see for quite a while right now, even though more and more analysts right now start to make it a topic. So I have to somehow smile a little, in fact, because I'm aware of this development for quite a while already, and I now see that probably this move is about to come to an end, based on the fact that many more analysts start to make it a topic now, that the media takes over here. And I think the driver here for dollar yuan now lower, sharply lower probably, will be that Donald Trump will intervene in some way. And how can he intervene? I mean, for example, trying to somehow down talk the US dollar, which he somehow already started to do yesterday in the evening with this interview on CNBC, where he just mentioned that he thinks that hiking, or that he does not like that the Fed is hiking rates. So, and now the thing is, let's have a look here of what the Chinese already did during the last 48 hours. That was already a tweet from in the morning. Some of you probably know this Twitter feed here from Zero Hedge. I highly recommend following it. There's lots of very good information. And so what happened was that China did in the last 48 hours did the following. It cut its 7-day treasury rate by 103 basis points, so more than 1%. It launched a quasi QE, quantitative easing. It told banks to flood the system with liquidity. How can you imagine this? That means nothing more than the Chinese government told some of its biggest banks, Chinese-owned banks, or government-owned banks, let's call it. It told them to sell US dollar to stabilize the Chinese yuan and to make sure that the devaluation of the yuan currently taking place is somehow reduced, that the Chinese yuan can stabilize. And why should they do this? Well, because this development here, is right now in favor of the Chinese economy, and could be interpreted as a countermeasure from the Chinese government to say, okay, we expect, based on the tariffs announced from the US and potential tariffs coming from here, we expect a negative impact on our economy. And to counter this negative impact, we devalue our currency here to somehow support our export in this case here. So now the thing is, it's not only that, but if this cycle here starts to, or if this measure starts to accelerate, we can also see capital outflows out of China. And capital outflows out of China in such a highly leveraged environment, which we find ourselves in, the Chinese economy currently, and for quite a while already. So look back at what happened in 2015, for example, 2016. The thing is that the Chinese government has to make sure that if such capital outflows really happen, as they do currently, that they nevertheless do not happen too aggressively, as they obviously happening right now, because this move is starting to get parabolic here. And this is potentially also meaning it starts at least to scare somehow people, probably market participants, that those developments here in China could spread over other current countries, other financial markets then, and start to result in kind of sharper spikes in volatility, for example. And based on the fact that there is a strong dependency on the Chinese economy too. That's especially true for emerging markets. That's true for Australia. You can surely think that rather sooner than later, if this can't be stopped, those capital outflows of the Chinese economy, that this could result in a global recession potentially. And this is something you definitely want to avoid. And this is, by the way, also something you should remember when looking at the comments from Donald Trump. So I'm not really sure if he sees this happening right now. So the question is, will there be any comments in regards to this development here? If they are, they will definitely aim to not trigger further or future moves in dollar yuan, for example, higher, pushing it higher, meaning nothing more than he will definitely try to somehow down talk the US dollar here to some extent. And while said this, let's have a look here back at this. The thing is, he also, or in this case, the PBOC, respectively, Chinese government, warned that more easing is coming. I mention all this, by the way, in detail, because this also has some big impact potentially on what to expect around the euro. But there's something we want to have a look at a little later on. So the thing here around China is that we potentially should expect, rather sooner than later, Donald Trump to make a statement which addresses this devaluation in Chinese currency, and which could then trigger at least short-term volatility, potentially a very sharp volatility push higher here. And this could also, and especially spread over, by the way, to the equity markets. So, and this is something to do with the fact that we already, or not already, but that we saw from the spike in volatility in the VIX, for example, in February, the Dow Jones, or in the VIX in this case, and the volatility, high volatility. And so currently, we are trading at the lowest volatility levels since the end of January, which shows that the market participants already started to aggressively sell a volatility again. And this could then, if this situation here around the US and China around those tariffs and the trade war fears escalates, result in really sharp and high volatility in all equity markets. So now, all this said, you might say, okay, probably it's a good idea then to short the US dollar, meaning nothing more than like going Euro USD long, for example, Pound USD long, or also dollar Japanese yen short. This, yes, to some extent, could be the could be something we could sum all this up. Now, the only problem is that when looking at the commitment of traders report here in the US dollar index future, what you can see is that we are about to attack a very significant and crucial region around 95 points. So this is here, this region. And with this region to be attacked here, and the fact that, and this is something you can see here within this green line, the green line is what we focus on here. It's the large speculators. This is CTAs, hedge funds. So it's big markets participants who have to deliver their futures position here to the CFTC in this case, and this is then published in this commitment of traders report. What you can see is they are currently long positioned, yes, but compared to how long those large speculators were shortly after the election of Trump in November 2016, respectively at the beginning of 2017, compared to this, the positioning of those big speculators seems to be, well, below what you should expect. Meaning nothing more than if the US dollar now breaks out, because and this is the interesting thing about this, the market, and you can see it, for example, when looking at the Euro USD here. So the interesting thing about this is, we can also look at the daily chart. The interesting thing is, all in all, the market, the FX markets so far did not react at all to this move. So this could somehow mean that right now, even though the comments from Trump were capable of pushing the markets in one direction here after his comments on the Fed yesterday, nevertheless start to get somehow used to these comments and start to price it in. And so the impact of any comment coming from Trump right now, it could be via an interview on CNBC, it could be via a tweet, whatever, it could be that the market just ignores it. So even though there is some serious skepticism building, if the US dollar has such a big chance to rally, when looking at the current volatility in FX markets, it seems as if the market does not care about it, respectively, after short-term volatility, which is starting to get, by the way, lower when looking at the FX markets, potentially higher in equity markets, which do not see as high liquidity or respectively depth as the FX markets, for example, the markets just shakes it off, if you want. And this means that we're probably, even after those comments, about to see a push higher and a quite sharp move, because a significant break above 95.50 probably could mean that those speculators who are currently not as aggressive long positions as they potentially should be expected to be could somehow probably be caught on the wrong foot, let's say, and have to buy once the market breaks above 95 to 95.50 here in the US dollar index future. So if this really happens, it could mean that the US dollar will see some serious strengthen within the next days of trading, the next trading week here. And with the economic docket being quite thin, and the next really important news coming out on Thursday, even though we shouldn't really expect it to be a high volatility event, the ECB rate decision here, and probably the growth rate, the GDP growth rate numbers here on Friday could be considered to some extent to be interesting. But all in all, the economic docket is quite thin. That means nothing more than that such a break could at least result in some bigger bullish moves in the US dollar in the upcoming days then. This said, by the way, and now let's come back to the Euro USD, and now things, I think, really start to get interesting with having a look also on the ECB rate decision. What I can say about the US dollar index future here is that here, this basket against which the US dollar is calculated consists to 58% out of euro. Then we have something like 13-14% Japanese yen, another around 10% on the pound sterling, meaning that this adds up to nearly 80% of the overall basket, those three currencies. That's also one of the reasons why we focus on them. But only looking at the euro here, that means that if such a push higher happens, it means nothing more than the euro should be expected to go lower from here. And currently, it really looks as if we are trading in the middle of nowhere. Nevertheless, and especially yesterday, I mean, chances were quite good, I think, that we will see a push of towards 115, towards this green line here. Nevertheless, the market started to reverse and trade back significantly above 116 after already pushing below 116 here into the evening then, based on those comments from Trump. Nevertheless, I think there's still a good chance that we could get to see such a push lower. And rather sooner or later, there will be another attack of this region. We can already say it's quite significant, meaning nothing more than if we break below 115 here in Euro USD, it wouldn't come as a big surprise to see a quite dynamic and a strongly accelerating move on the downside, which could easily then push us as low as 112 within the next days, in fact, and also resulting in a follow through on 95 in the US dollar index future then. So you can nearly take those two markets then completely inverse to each other, respectively negatively correlated to each other. So that said, looking at the hourly chart, you can already see it here. So there's a tendency of falling highs and falling lows already, even though dynamic definitely looks different. Nevertheless, there is somehow a tendency that will more likely get to see a test of 115 instead of trading sharply higher, even though it's definitely very difficult to right now formulate a trading setup, because the market after yesterday, for example, thanks to yesterday, that perfectly illustrates where we're currently at. The thing is that the market, for example, builds a sequence of falling highs and falling lows here, and then after this push higher, we see this let's call it interrupter. So the market is then trading towards and shooting above this last relative high here, which was formed there, even though it's not breaking the structure. But it makes things really difficult now to trade Euro USD short. What I could imagine is to really start to try the following. Let's put it that way. Try the following. So probably it makes sense to scale into the Euro USD short here with the target to anticipate a break below 115. So what does this mean? That means nothing more than that you decide on which risk you're willing to take. Let's say if you decide to say or scale into a trade, yes, how to say that, I don't know. Which risk am I willing to take? That means, for example, let's say you're trading a 10,000 euro account. 1 second, please. Okay, so you're trading a 10,000 euro account. That means you're willing to take a risk of 100 euros, 1%. If you then say, okay, I split this position here, and I try to scale into a trade, starting with a risk of 1/3 of this 100 euros, so something like 30, 35 euros risk when taking this position. So shorting a break here below this level around 116.20, it's 116.20 around. So shorting here, starting with a stop. This is the initial stop here. And then hoping that the market will continue to build a structure like this. So probably not sure if it really happens, because as you can see, the market is already quite volatile. This could be the level where you put then the second position to your initial one, also with 1/3. Question is somehow, do I really want to work here with a stop too tight at the current market? Because the problem is that, again, the overall mode is quite choppy. So probably the stop for those two positions should be here, even though, and this is the interesting thing, even though if here this position you add to this, the average price probably goes to this level here. So that means you have already 2/3 in the market, meaning 60, 70 euros or something like that. But with a stop here at this level, the thing is that the overall risk of the position is still below 1% of your overall trading equity. So it's a quite conservative way to scale into a trade here. And then try to do the same before we attack the region of 115. I mean, sure, we highly depend on whether the market will really build such a structure or not, sure. But nevertheless, for illustration purposes, I think it makes definitely sense to just show how this could work. At a third position here, and this is then already a point where you can probably start to move your stop, depending on where the relative stop is, and also having a look, for example, at the 14 RTR, for example. So looking at the average true range, for example, the volatility in the market, and then trailing the stop to a level where you start to take out the risk already, nevertheless giving the market enough room to breathe, to attack and break significantly below 115 here. So the region around this green line on the downside. So this would be my current idea. And by the way, I consider the risk reward of such a trade, as I already said, I consider it to be really good, because the reason for that is simple. Looking at the devaluation of the Chinese yuan here, I could imagine this to happen here to the euro too, to some extent, and that the ECB, probably even more than the People's Bank of China, is not really unhappy to see such a devaluation. So wouldn't step into the ring here and say, oh, we don't want to see the euro drop or something. And but probably start to really accelerate such a move with certain comments to also play the ball back, let's say, to the US here in terms of all the comments Donald Trump made, not only to the EU, but also towards the Germans, for example, and the automobile sector. There were several and many, in fact, of comments he made. And by the way, I just want to give you, let me just look this up here. So there was, shortly before we started this webinar, a comment from Angela Merkel, the German chancellor here. She said that the European Union, is ready to retaliate against any US auto tariffs here. And so the interesting thing about this is now that with such comments, I mean, it becomes somehow likely that it's a good chance. There's a very good chance that if there are such tariffs, that here in this context, then, even though Merkel knows, and that's something she also mentioned during this speech she just gave, that tariffs are not positive, but that the European Union starts with a quite aggressive devaluation of the euro. And where could you start such a devaluation? Well, and this is why, from a monetary policy perspective, the rate decision is not that interesting next Thursday, but it's starting to get really interesting in terms of the comments Mario Draghi will probably make at this event then. Probably there will be a journalist asking a certain question. What do you think about the trade war and everything? Draghi has been very diplomatic during his career as a ECB president. Nevertheless, I think, let's say, things start to heat up a little, let's put it that way. And I could really imagine Mario Draghi to make a comment which will push the euro sharply lower. Probably saying something like, yes, sure, I mean, we look at those developments. We won't tell you how to counter such tariffs if they really come into play. Sure, we plan to discuss with our trading partners, respectively not Draghi, since also the ECB is independent from the politics here. But nevertheless, there will be probably some comments, and then everything seems to be running smoothly and very diplomatic, and then it wouldn't come as a surprise when Draghi says something like, yes, and sure, if there's some kind of negative impact on the European economy based on such tariffs, sure, we have to see if probably ramping up our QE program again to devalue our currency, to counter any negative impacts on our economy, is probably an option or not. Sure, we will discuss this. If this is the only thing he needs to say. It's really neutral to some extent, even though everyone can read between the lines, and the euro could really smash significantly lower from here. And that's one of the reasons why, on the one hand, the rate decision, even though everything is already set and there's no big surprises from monetary policy perspective, there's no big surprises to be expected anymore. The volatility of this rate decision could really be quite big after the comments from Draghi. And by the way, the great thing about this is that 1 week from now, you can already register here for next week's webinar. 1 week from now, so 1 day after this rate decision, we'll sit together here again and have an outlook on the developments on the markets, give an outlook for the upcoming trading week. Then, nevertheless, have a look back to 1 day before and what Draghi just said. And I wouldn't, by the way, I wouldn't be surprised if anything is announced there which pushes the euro significantly lower and probably resulting in a quite significant attack at 115, while the US dollar index future pushes significantly about 95 in this case. So what does all this mean then for the equity markets? So now we talked a lot about currencies, but probably, by the way, also interesting, and completely the opposite of what I just brought up here, but something probably worth mentioning. So you can't be really sure in which direction all this will go. We really do not know. Nevertheless, if you're 100% technical trader and looking at the current developments here in GBP/USD on the daily chart, what you can clearly spot is a bullish divergence forming, and this bullish divergence, some of you probably are willing to say, hey, we've seen already such a aggressive nosedive, let's say, in pound sterling here on the downside. So probably we are about to see a quite sharp reversal here. And sure, this is definitely an option. Nevertheless, I'd do the same as I did here. I'd scale into such a trade, into such a reversal trade. I wouldn't go 100% long, very aggressively long here, because we are bearish as long as we trade below 134. So this is the high here from so the July highs, in fact, here. We're trading below them around 134. And there's, again, also the chance, and this is something to remember, the euro and the GBP, they are both strongly negatively correlated to each other, positively correlated to each other. So meaning if one goes up, the other should go up too, while the opposite is true as well. Meaning if the euro goes down, also pound sterling shouldn't be expected to go up in this case. Probably pound sterling presents itself a little more stable, something we definitely have to wait for. But what I want to emphasize here, first place, is even though this bullish divergence is forming and could be an indication that the momentum, the bearish momentum on the downside diminishes, and that we are about to see a sharper reversal move, we are still bearish below 134. And if you plan to trade the long side, in this case in pound sterling against the US dollar, you should probably scale into the trade here too, starting with a smaller than usual position size, and then build this position if it really starts to move higher from here. If the US dollar really starts to push lower, does not make it above 95. On the other hand, anything about the Brexit negotiations goes in favor of the United Kingdom here. Usually should result in a sharper rise than in pound sterling, for example. The overall politic uncertainty around Theresa May starts to diminish, whatever. So all this could definitely push pound sterling against the US dollar higher. But nevertheless, remember that this is right now only an indication, and with the look back at the euro and the skepticism, which is definitely necessary to make it a topic, and it's definitely a fair statement to say there is a big and good chance, that's not a big one, but it's a good chance that Draghi will somehow announce something which aims to push the euro lower. If you consider this, pound sterling could also be one of those currencies losing based on the positive correlation of pound sterling and euro in this case. So now let's look at the equity markets. Let's look at the DAX here in this case. And by the way, I just saw that I forgot to include something. I need a moving average. Where is it? Here. Oh, no, that was not the right one. It was the parabolic, but I want to have here the moving average. So what do I need is 200, and the simple moving average completely gets the job done. So this is a 200 simple moving average, big trend filter viewed by many market participants and also institutional traders. And the interesting thing is that after we broke sharply below this here again in June, now we traded back to this level, nevertheless didn't make it back. So it's a strong resistance, obviously. And we weren't capable of making it back above that level. So now the interesting thing is, what can we make out of all these different developments here around the euro, for example? And the thing is that it's somehow counterintuitive, because if Draghi, for example, really tries to down talk the euro, okay, that means that the trade war fears should start to take momentum and start to be a big topic again. And this is usually something which is expected to be bearish for the equity markets. Now, nevertheless, the thing is that short-term, such a devaluation of the euro, if it's really brought up, the thing is that short-term, it could be bullish for the DAX. But as long as we trade below this 200 simple moving average, I'd say we should be really careful to take long positions. Nevertheless, if we make it back above that level, and you can find the highs around 12,770, 780 points, well, then there's definitely further bullish potential given, which could, within days probably, push us as high as 13,200 points. Nevertheless, everything below this purple line in this case should be considered really skeptical here, and we shouldn't trade the long side too aggressively in the DAX. Nevertheless, there could be a serious attempt to break back above this 200 simple moving average next week on Thursday with the ECB. So if the ECB really comes out, or Mario Draghi really tries to down talk the euro, especially the DAX could profit from this based on the export orientation of the German economy here. And a lower euro obviously is positive. Nevertheless, the thing is, it depends on the other hand on how Trump would react to this, how the White House would react to this. If there is probably an anticipation of such a step from the ECB, also an opportunity, and that probably Trump will start to attack the Germans again, for example. The interesting thing about this is if trade war fears start to escalate, this is not only true in regards to the EU, but also to China. Let's see what happens over the weekend. I think right now it's really difficult to say anything. In fact, in the morning I had a discussion that was with German traders. The thing is that there I said, well, within minutes things could turn, and you don't really know in which direction, based on those comments. You really do not know in which direction the comments, in this case from Trump, will come out, tweets, whatever, and how he surprises the markets. Shortly after, markets plunged, and the DAX saw a drop of something like 150 points based on this comments on China again. The same is true on the other side, and now we have a weekend in between. We have a very thin market in general. We have vacation, so it's really difficult to say in which direction currently the market will push, and that's one of the reasons also I highly recommend to reduce the leverage or your positions in especially equities then, but this is also true for currency markets, but mostly important for equities, because really do not know in which direction such comments over the weekend could come out. And the interesting thing about this is especially true when we're looking at the CBOE, the volatility index. So currently, now we're drifting back above 13 here. Nevertheless, it's surprising to see how low volatility is compared to all those tensions around the globe, around trade war fears. It's really impressive to see that. It's impressive to see something we don't want to open right now, but we'll look at this on Monday on the VIX then, also because then we have updated data here. Currently, there's over 50,000 contracts net short in the VIX future at the CBOE. So market participants start to aggressively sell volatility again because they think nothing will escalate. Everything's fine. Everything's cool. We are about to see an inversion of the yield curve in the US, usually an indication, even though it's not tomorrow that there will be a recession. Nevertheless, it's a clear sign forming at the horizon saying, hey, there will be rather sooner or later a recession. That has been the case in 9 out of 9 cases in the past, and it will be most likely in the future too. Ben Bernanke over the week just said, well, probably this time is different. That's the same Ben Bernanke who just, not just, but who said in 2007, shortly before the subprime crisis hit the markets and resulted in the worst financial crisis ever, who said everything's fine. So the thing is that it's surprising to see, and this is not only true for the equity markets, but also for the FX markets, but here we want to focus on the equity markets, how sure market participants seem, how underinsured, let's say, markets are when looking at the current readings in volatility here. Why do I mention this? Let's put it that way. In the DAX, everything seems to be fine as long as we trade above 12,400 points. But if we drop below this level, and for example, Mario Draghi can't really deliver something which supports the DAX, or only short-term supports the DAX, and afterwards the DAX takes on serious momentum on the downside, things could start to turn very ugly for the DAX within days, because then after breaking below 12,400, the next target can be found around 12,100. And if we go below this level, the next target can be found around the yearly lows. So that said, chances are good that we are getting to see a quite hot summer. And it all could start, in fact, over the weekend now, respectively, within the next days. And then we close the cycle. It all could start with a comment from Donald Trump on this aggressive devaluation of the Chinese yuan here, which could trigger significant volatility in the FX markets too, which could lead as a pre-indication for equity markets. And by the way, looking at dollar yuan here means also if Trump really goes after the US dollar, tries to down talk it, that means that euro could also push higher, and the higher euro then is negative per se, for the DAX in this case, export-oriented country, Germany, and so it's definitely a very, very exciting environment in which we currently find ourselves in. Just finally, probably look at my position. So some of you might wonder now, okay, great. I formulated an idea to somehow anticipate a break here lower, and a break of 115. So what's your current position in the markets? So in fact, I'm currently flat. And my main traded asset is, in fact, not the Euro USD, but it's the DAX. But I haven't traded the DAX since Tuesday. Some of you might have seen the push higher, which I was lucky to catch, in fact, even though it took a while until the market really took off from here. that was mainly due to the fact that there was a small expiration today at the Eurex, by the way. But now the thing is that after seeing this sharp push higher here, or this short squeeze, I cashed in the chips, in fact, and I know that the upcoming day from here, I would have been short, while I somehow felt that we are not yet done on the downside. I'm sorry, on the upside. So I was capable of outperforming my basic strategy here for 49 points in this case, I think, something like 50 points, yes. And then I knew that yesterday, for example, the DAX, or my system, my basic strategy would have been long. I was still flat, not really knowing in which direction the comments from Trump will come out, but also mainly due to the fact that the overall market structure wasn't or isn't that nice. And that said, I just didn't take the long side yesterday. Turned out to be a really good decision. Was another 60 points, something probably slightly more. So I outperformed over the last 2 trading days the DAX here for over 100 points in relation to my basic strategy, which is a very, very good result. And by the way, not only this time, but I'm doing this over and over again and document it, and then I see whether I perform better than the basic strategy or I don't. And if I don't perform better, well, usually I should only just let the basic strategy run because my decisions are bad. So far, plays out good. So long thing short, I'm still flat. I'm happy to be flat because also today I would have been long, and currently the market is trading lower. And the thing is that probably on Monday I'll start to trade again, but this depends highly on how things develop over the weekend. So I'm still not yet positioned. So I'm working with an expert advisor here and working with an automated trading strategy. And I plan to bring the system up again if things start to de-escalate from a political landscape. But let's just see. I the current trade frequency and probably also reduce the leverage, especially reduce leverage in your trading due to the fact that we can't be really sure in which direction markets will push here. I mean, we can't be sure every day, but it's also currently very difficult to calculate the risk based on the thin liquidity and potential for slippage and all this. And so let's finally have a look here at the website from Admiral again and the webinars, which will take place then. Next week onwards. We'll meet again 1 week from now on Friday. Again, let me just see if this, no, not yet updated, but it will be updated here within the next trading days with the next webinar then, the weekly market outlook. And so that's it from my end. Make sure that you register for the Asthma new CFD regulation in Europe here, 3 special webinars. And that's it from my end. So have a nice weekend. Enjoy yourself. Take care. Talk to you again next week. I look forward to it. See you and bye-bye.